In this module, we shall learn about the capital formation and national income. Let us commence this module by discussing about capital formation. Capital formation means the net capital accumulation during a specified accounting period, or in other words, it is the net additions to the capital stock of a nation, such as equipment, buildings and other intermediate goods. This capital stock is in turn used in combination with labor to provide services and produce goods and commodities. Therefore, an increase in this capital stock is known as capital formation. National income is defined as the total amount of output, goods and services produced in an year by the country's productive system in the hands of the ultimate consumers. National income is also defined from the income and expenditure point of view. After studying this module, you would know the meaning of capital formation, learn the different components in a nation's capital stock, analyze the methodology to calculate capital formation and its process, know the meaning and the methodology to calculate the national income of a nation, evaluate the relationship between savings, capital formation and national income. Let us discuss the meaning of capital formation in detail. The term capital formation and investment and saving are used interchangeably, partly because the concept of capital can be understood in different ways. The relationship between the three is crucial for national income accounting. Here, all three terms are defined clearly as follows. Savings. It is that part of current disposable income that is not spent to consume final goods and services. Investments is that portion of capital which is actually used for investment purposes and not held as savings or consumed. It includes investment in capital assets, both tangible property or financial assets. Capital formation. It includes the money spent to buy capital goods, not include financial assets such as stocks and securities for future expansion of production capacity. Thus, saving withdraws sum of money from the financial system, while capital formation injects sum of money into the financial system. Next, we shall discuss the various methods to compute capital formation of an economy. CSO in the book National Account Statistic Sources and Methods has given a methodology to estimate GDS and GCF. The latest as per published by 2007 CSO 2007A, the methodology followed for the estimation has been described briefly in this section. First, methodology to calculate gross domestic saving. First, public sector saving. The difference between current receipts and the current expenditures from the total saving of government administration, quasi-bodies and departmental enterprises. The current receipts includes the income from business and property, direct taxes, indirect taxes, etc., while on the other hand, the current expenditure covers total consumption expenditure, payments in the form of interest, subsidies and current transfers. Second, private sector saving. For private companies, the total savings of public and private limited companies is estimated as the sum of retained earnings adjusted plus the depreciation provision. Retained earnings means those earnings which are reinvested in the business after making payments towards provision of tax, interest, dividends and depreciation provision for various fixed assets. Third, household sector saving. Financial saving and saving in the physical assets is the major savings for this sector. The amount of financial saving are derived by observing the changes in financial assets with the households in the form of currency certificates, deposits with financial institutions, shares and debentures, government claims, equity in the life funds, provident and pension funds with the changes in the financial liabilities. Thus, the financial saving of the households are derived as the increments in the financial assets net of increments in their financial liabilities. Second, methodology to calculate gross capital formation. Capital formation includes all expenditure done on increasing the physical stock in an economy. For example, gross increment in fixed asset addition to machinery and equipments, change in inventories, software and net acquisition of valuables during the period of account are all grossed up. The total amount of construction is obtained as the total of new construction including major repairs and replacement and current repairs and maintenance. First, capital formation in construction. This approach is adopted for evaluation of estimates for Pakka construction. It consists of total expenditure including material inputs, cement, steel, bricks and wooden fixtures and payments towards factors of production. The total estimates for Pakka construction for the two different sectors, namely public sector and private sector, are balanced using budgetary documents, profit and loss account and the financial statement. The estimate of Pakka construction for the household sector is then estimated as residuals. Second, capital formation on machinery and equipments. The capital formation for machinery and equipments covers X factory value of capital goods produced in the registered and unregistered manufacturing sectors, excise duties paid, net imports of capital goods, import duties, investments in livestock and installation charges of wind energy system. Estimates of current stock at current prices in machinery and equipment is prepared by commodity flow approach. Third, capital formation by valuables. A different category under produced fixed assets separately from the GF, CF and changes in stock is estimated based on net acquisition of valuables on precious items like diamonds, silver, gold, gems, ornaments, etc. The monetary gold has not been considered as a part of valuables. Further, let us understand how to calculate national income. A. Gross domestic product GDP. GDP is the total value of goods and services produced within the country during a year. This is calculated at market price and is known as GDP at market prices. There are three methods to calculate GDP at market price. First, the income method. Under this method, all incomes received by the factors of production generated in the economy during a year are added together. It includes payment for wages on both employment and self-employment, profits, interest to lenders on capital or rents to owners of land. Second, the output method, product method. Under this method, the combined amount of the new and final output produced in different sectors of the economy including manufacturing, financial services, transport, leisure and agriculture is taken into account. Third, the expenditure method. Under this method, all spending of the economy by households and firms on new and final goods and services by households and firms are added together to calculate the national income of an economy. B. Gross Domestic Product at Factor Cost GDP FC. GDP at factor cost is the net value added by all producers within the country. GDP at factor cost is equal to GDP at market price less indirect taxes. C. Net domestic product NDP. NDP is the net output of the nation during the year. Capital assets wears out or becomes obsolete each year during the production process. Thus, net domestic product is equal to GDP at factor price less depreciation. D. Nominal and real GDP. When GDP calculated on current price is called GDP at current prices or nominal GDP, while when GDP is calculated on the basis of fixed prices in some year, it is called GDP at constant prices or real GDP. To find out the real GDP, a base year is chosen when the general price level is normal. That is, it is neither too high nor too low. The prices are adjusted on 100 or 1 in the base year. Real GDP is equal to GDP for the current year into base year, which is equal to 100 upon current year index. Suppose 1980-81 is the base year and GDP for 1989-1990 is rupees 6 lakh crores and the price index for this year is 300. Thus, real GDP for 1999-2000 is equal to rupees 6 lakh into 100 upon 300, which is equal to rupees 2 lakh crores. E. GDP deflator. GDP deflator is a barometer of price changes of goods and services included in GDP. It is a price index which is calculated as follows. GDP deflator is equal to nominal or current prices GDP upon real or constant prices GDP into 100. F. Gross National Product GNP. GNP is the total difference in the flow of goods and services at market values resulting from current year's production of a country. It also includes the net income from abroad. GNP includes the following final goods and services. First, consumers' goods and services which satisfies the wants and demand of people. Second, gross investment in capital goods consisting of total capital formation, household construction and inventories of finished and unfinished goods. Third, goods and services manufactured by the government and its organizations. Fourth, aggregate exports of goods and services, that is the difference between value of exports and imports of goods and services known as net income from abroad, NIFA. The factors to be taken into consideration. First, GNP is the sum of money in which all kinds of goods and services manufactured in a country during 1 year are measured in terms of money at current prices and then added together. But in this manner, due to the fluctuations in the prices, the GNP is increased or declined, which may not be real. To guard against erring on this account, a particular year, base year, when prices are normal is taken and the GNP is adjusted in accordance with the index number for that year. Second, in estimating GNP, the market price of only the final products should be considered. Many of the products pass through different number of stages before they are ultimately purchased by consumers. If these products are counted and calculated at every stage, they would be included many a time in the national product. Consequently, the GNP will increase too much. To avoid dual counting, therefore, only the final products and not the intermediary goods should be taken into account. Third, goods and services given free of cost are not included in the GNP because it is not difficult to have a correct estimation of their market value or price. For example, the bringing up of a child by the mother, giving instructions to his son by a teacher, recitals to his friends by a musician, etc. Fourth, the transactions which do not arise in the current year or which do not contribute in any way to production are not included in the GNP. The sale and purchase of second-hand goods and shares, bonds and assets of existing companies are not included in GNP because they do not make any addition to the national product and the goods are simply transferred. Fifth, the payments received under Social Security, example unemployment insurance allowance, old age pension and interest on public loans are also not included in GNP because the recipients do not provide any service in lieu of them. But the depreciation on machinery, other capital goods is not deducted from GNP. Sixth, the profits earned or losses incurred due to fluctuations in market prices in the value of capital assets are not included in the GNP if they are not responsible for current production or economic activity. For example, if the price of a building or of a bare land has increased due to inflation, the profit earned by selling it will not be a part of GNP. But if during the current year a portion of a house is constructed anew, the increase in the value of the house after subtracting the cost of the newly constructed portion will be adjusted in the GNP. Similarly, variations in the value of assets that can be ascertained beforehand and are insured against flood or fire are not included in the GNP. Seventh, the income earned in restricted activities is not to be incorporated in the GNP. Though the goods sold in the black market are priced and fulfill the needs of the people, but as they are not useful from the social point of view, the income received from their sale and purchase is always excluded from the GNP. G. GNP at market prices. To convert gross domestic product into national product, we must add the total income from abroad into a nation. GNP at market prices is equal to GDP at market prices plus net income from abroad. H. GNP at factor cost. GNP at factor cost is the sum of the money value of the income produced by and accruing to the various factors of production in 1 year in a country. GNP at factor cost is equal to GNP at market prices less indirect taxes plus subsidies. I. Net national product NNP. NNP is sum total of output on consumption goods and investment goods. But this practice of production uses definite quantity of fixed capital and the fixed equipment wears out with time, or other components are damaged or destroyed, and still others are rendered obsolete through technological changes. NNP is equal to GNP less depreciation. J. NNP at market prices. Net national product at market prices is the sum total of final goods and services evaluated at market price in a country. Value of final goods and services calculated, evaluated at market prices in a country. NNP at market prices is equal to GNP at market prices less depreciation. K. NNP at factor cost. Net national product at factor cost is the total output evaluated at factor prices. It includes income earned by factors of production through participation in the production process such as wages and salaries, rents, profits, etc. It is also known as national income. NNP at factor cost national income is equal to NNP at market prices less indirect taxes plus subsidies. Let us now summarize what we have learned in this module. In the overview, capital formation refers to the transfer of capital from individuals, organizations or government for business use. The company can then use the profit to encourage investment to expand its operation among other options. Capital formation is a crucial factor to evaluate the economic growth of a nation. National income refers to a sum total of goods and services produced within some boundary. This boundary is usually the geographical boundary or citizenship and may also control the goods and services that are counted. For example, some measures do not count goods and services that are exchanged for money, but excludes goods exchanged in barter transactions. While on the other hand, the other measures may try to take account of bartered goods by imputing monetary values to them.